this trading around, this trading range, you as a trader and investor, but as a trader also, understand that when you build a base like that, one of two things is going to happen. It's either going to break down, and that's what a lot of the bears have been betting on, and they've been throwing everything at it, or it's going to break out. Clearly, we believe it's going to break out. And the longer the base, you say 5 years, the longer the base, the bigger the breakout. So we're really looking forward to that.
The longer the base, the bigger the breakout. Wise words once said from Cathie Woods. And you've definitely seen a very long base in Tesla. And from that perspective, you've only just started to see the actual breakout. Now, here in this video, I will explain again why December is likely going to be a great month for Tesla. In fact, Tesla could be a $450 to $550 stock by the end of December, depending on how large this gamma squeeze is and the short squeeze, if that actually happens. I explained in the last video, and I will do so here briefly, that imagine it like this. If you're a hedge fund or institution, let's say you're up 25% on the year, you've kind of matched what the S&P has done, you have a lot of gains in areas that you're going to get taxed on, but you have this big short position in Tesla that you're down a lot on. It makes sense to cover on that Tesla short position to offset some of the gains that you're going to pay on other stocks in your portfolio. And that's one reason why the end of December specifically could get pretty crazy to the upside for Tesla. If short sellers actually start covering on short positions, you could see not only a gamma squeeze, but also a short squeeze, which could send the stock much higher. With that said, in this video, we will discuss what events are going to be happening this week from earnings, from economic data, and how this is all going to affect Tesla stock. Now, believe it or not, you still do have quite a few important earnings still in this upcoming week. It seems like earnings season never ends these days. In Monday and after hours, you have C3 AI, Oracle, MongoDB, Planet, Toll Brothers, Braze, Casey's, and Vail Resorts. Tuesday pre-market, you have AutoZone, Ollie's, Ferguson, and others. Tuesday and after hours, you have GameStop, Stitch Fix, Dave & Buster's, and Skillsoft. Wednesday pre-market, you have Macy's. Wednesday and after hours, you have Nordson, and Adobe. Thursday, you have Broadcom, Costco, and Restoration Hardware in after hours. So really some of the big ones here, C3 AI, Oracle, GameStop for some of your more momentum traders. Wednesday, you have Adobe, you have Costco, right? Again, Broadcom. These are very large market cap companies. Adobe, Costco, Broadcom, hundreds of billions of dollars a piece in market cap. And they all kind of have their own stories, but specifically Broadcom, that's important for that AI name. There's a lot of people that are bullish on that. Macy's important for retailers. Adobe, C3 AI, and Oracle important for the AI software trade. So don't count some of these earnings out just yet and the impact that they could have on markets. But really, analysts had their estimates far too low for this earnings season. We were over 500 basis points higher in the average, S&P earnings estimate, which is crazy, right? That means 5% higher than Wall Street was projecting. Wall Street was projecting like 3% year-over-year earnings growth for the S&P this quarter, and we're actually coming in closer to 8%. So that was a big upside surprise. That's part of the reason markets have moved higher recently. And I do think as long as these companies do not report some disaster, then it's going to be seen as a positive for markets. Now, as far as the economic data is concerned, we talked about this in prior videos, and I will give you kind of the simplest explanation of this, okay? As long as nothing dramatically changes, as long as we don't have, to some degree, a black swan event in the economic data, markets want to go higher. And you're just knocking out risk catalyst during a very bullish, seasonally, bullish period of the year, okay? In fact, Tom Lee pointed this out. We talked about this in prior videos. But in the month of December, historically, you're positive about 75% of the time. Okay, this is looking at the last, 150 years or so. Okay, but during election years, when the S&P is up 20% for the year, which yes has only happened a handful of times or so, December tends to be positive about 3.5%. 100% of the time. You've never had a red December during an election year with the markets already up 20%. I don't think this is the time where that starts, okay? I think people want to be bullish. I think momentum is to the upside. And as long as nothing dramatic happens, the path of least resistance is higher. So with that said, here is a kind of full breakdown of what to expect this week. Now, on Monday, you have wholesale inventories month over month for October, expecting positive 0.2%. This is really only important because it feeds into your GDP estimates from the Atlanta Fed. And the Atlanta Fed GDP now tracker is at 3.3% GDP. So you're going to get a new update. It says here Monday, December 9th. That is from that wholesale inventories number. So a big up move or big down move can move the expectations for GDP. More importantly, on Monday at 11 o'clock in the morning, and wholesale inventories come out at 10 a.m. At 11 a.m., you have consumer inflation expectations. This is generally for the 1 year ahead period, and you are expecting this will increase from 2.9% to 3.0%. Personally, I think as we head into 2025, the higher inflation expectations are, the bigger a catalyst it will be when inflation actually comes down more than expected, because I don't think 2025 is going to be a year where we see a lot of inflation, right? I think it's going to be a year of solid disinflation. Just my opinion. So the higher those inflation expectations go, the more people expect higher inflation. It's going to be a larger positive catalyst when we get lower inflation. So definitely something to watch for there. Tuesday, you will get final numbers for productivity quarter over quarter and unit labor costs quarter over quarter, the WASDE report, and a 3-year bond auction, as well as a 42-day bond auction. But those are not usually important. So Tuesday's going to be a bit of a slower day. On Wednesday, you have core CPI month over month expecting 0.3%. Last month was also 0.3%. Core year over year is expected at 3.3%. Last month was 3.3%. So you're expecting really a lot of the same numbers on a month over month basis. Inflation month over month, again, expected at 0.2%. Last month was also 0.2%. Headline inflation year over year is expected, though, to rise from 2.6% to 2.7%, but I don't think that's a huge deal breaker, right? And I think with expectations this high, especially for core, there is a chance that we surprise to the downside versus surprise to the upside. So most likely you'll come in at 0.3%, but I think if we were to surprise, the chance is we surprise to the downside. Some of that has to do with energy markets. You have seen oil fall specifically in the month of November as Trump won the election. Oil fell from a high of about $72 a barrel down to where you currently are now at $67 a barrel. Now, I know core strips out food and energy. Okay, I know this. But pick up anything you got right now. What I'm drinking right now, these V8 Plus energy drinks. I mean, if you're going to drink energy drinks, like drink these, okay? It's purely fruit juice with no added sugars, 4% of your daily carbohydrates, like literally nothing, with a bunch of vitamins, right? It's fruit juice. This is the orange pineapple. They're all really good. V8 energy, okay? None of the toxic stuff that you're going to get in Red Bull or Monsters or any of that. And it's caffeine from black tea, by the way. Like, did I make this? No. I got this from a store. VA obviously shipped it somewhere. So energy can never be stripped out of even core CPI, because everything, no matter if it's Tylenol or my favorite cologne, which is Dolce & Gabbana Light Blue, stuff smells amazing, lasts forever. Like, I still smell it like crazy, and I didn't even spray any today. Okay, none of this stuff I made, right? So all of it was influenced by energy cost. And energy costs are a thing with any company, so you can never strip it out. And I do think if oil stays at these levels, that's going to help the disinflation narrative. Who knows if that'll actually come through in November, but I think it will start to benefit inflation reports over the coming months. Now, Thursday, you will get PPI month over month, expecting an actual rise here from 0.2% month over month to 0.3% month over month. Core PPI last month was 0.3%, expecting 0.3% as well. Again, with energy producer price index, I think oil is going to be a positive, right? So I think you're going to come in lower than last month. Does that change the headline number that we get? Maybe, maybe not. There's, we obviously just round. So technically you could go from last month being like 0.27% down to 0.25%. Like that's a decline on a month over month basis. Slight one, less than 10%, still slight decline, but you'd still come in at 0.3% because you're going to round up, right? So that's definitely something to watch for. Initial jobless claims expected at 221,000. Last week was 224,000. It was slightly higher than expected. What you really want to watch here is if we see a big jump in initial jobless claims. That's what started the growth scare the last time around, okay? Earlier this year, July, August, September, when the unemployment rate was roughly where it is today. So the unemployment rate went up, came down a bit, and now it's right back up again via the last jobs report we just got on Friday. The only difference is, from my perspective, is the initial jobless claims have not spiked like they did during the earlier year growth scare, where we started to hit like 270,000 initial jobless claims. We're not there now, okay? But if you do see a spike there, I think that's really what the markets are going to respond to. You get a lot of other data as well related to PPI, but it's really this core PPI and a headline PPI month over month number that markets care about. And then on Friday, you really don't have much. You do have GDP numbers out of the UK, some data out of Germany, but none of that tends to move our markets too much. The only thing you have is export prices month over month and import prices month over month and year over year metrics. And this does feed into the GDP estimates from the Atlanta Fed. So that's something to watch at least a little bit, but I don't think it's going to have the power to really move our markets in a material way. So really in summary there, we do have some important data coming out this week. PPI, CPI, initial jobless claims. And markets could get a little nervous about that heading into it, but I think it's much the same as the jobs report we got on Friday. The jobs report was really not that good. It was actually kind of bad if you look at the household survey and others, right? The unemployment rate, for an example, it was not good, right? But what the VIX do? The VIX was down 5.7%. Down to the lowest levels we've seen in a very long time, down to 12.77. Okay. Kind of collapsed on Friday. Because why? As you knock out these risk catalysts, as long as the data is not too bad, then you're just knocking out risk catalyst. And markets want to move higher there. Okay. So that's kind of the essence of what I expect this week after CPI. As long as it's not bad, markets are going higher. If it's good, markets are going a lot higher. Okay, that's kind of the most blunt, easy way to actually put it. Now, what's also encouraging is when you look at like the fear and greed index, you're now neutral at 53. So almost exactly neutral. Whereas a week ago, you were at 67. Okay, so you have fallen in terms of I guess, internal market frothiness. I know stocks have not fallen that much, but kind of sentiment has reset a bit, okay? And that could drive a December rally for markets. I will also point out the percent of stocks trading above their 50-day moving average as recently as December 2nd was at 67%. Today it's at 61.45%. So you've seen about 5% of our markets 5% of stocks in our markets fall below their 50-day moving average in just the last couple of days. So you have seen momentum die down a bit. With a good CPI report or an inline CPI report, you could see a move higher in the broader markets. And that's what I think this week will really be. I think it's going to be a lot of positioning for 2025. I think the trade for 2025 is small, mid caps, and cyclicals, not necessarily your big tech names. So, take that as you will. Those are probably the areas that will outperform. We did see something strange recently in the AI investor sentiment survey. At the same time, CNN, fear and greed index, the percent of stocks above their 50-day moving average has been coming down. AI investor sentiment hit a 1-year bearish high on November 27th and then plummeted for the bears. The bulls skyrocketed more than 11 points. From 37.1% of investors that were bullish November 27th, very, very low number, to 48.3% that are now bullish. So we'll get another one of these coming out on Thursday. It'll be interesting to see what happens here, but a lot of volatility in generalized market sentiment. People feel good one day, they feel less good the next day. And it doesn't seem like there's a whole lot of rhyme or reason to it. Now, again, like I said, Friday, the jobs report was really not that great. So it did basically confirm a December 18th rate cut from the Fed. Again, as long as that inflation report is not like really bad, like 0.5% positive month over month for core CPI, you're going to get a rate cut December 18th. And I think that's something markets are also we'll see as a positive. Now, what you also want to be watching is the bond market, specifically 10-year Treasury yields. 10-year Treasury yields fell about 3.5 basis points on Friday, again, because of the lackluster jobs report that we got. And this is quite a big drop from where we were after the election, right? November, 12th or so, you hit 4.43%. You're down to 4.15%. Okay, you've started the downward trajectory, the trend. If you do continue to see that, that's going to be good. Now, let me take you back to the growth scare that we had September 16, 2024, where markets were expecting 7 or 8 rate cuts in 2025. 10-year Treasury yields fell to 3.62%. I mean, if we get the Treasury market that falls for the right reasons, which it looks like is happening now, again, jobs report was a little mixed, so take it for how you will, then that's going to be good and supportive for markets as well. Okay, so if the downtrend continues in treasuries, that's a good thing for markets. And specifically for Tesla stock, as we talked about in prior videos, I mean, there's not really anything to not like with Tesla right now, at least for the month of December. I do expect there will be a correction in early 2025. Whether or not Tesla meets the expectations for deliveries for Q4, that's another wild card, potential negative catalyst that could come, right? Early January or so. But from now until then, as long as we don't get any really bad news for Tesla, I think you're good. You already had the Kathleen McCormick shoot down Elon's comp package again. That did virtually nothing to stop Tesla. I just don't see the bear thesis into year end. And I think it makes a lot of sense for shorts to cover on short positions, to give us a further gamma squeeze, to get more people getting positioned to Tesla in 2025 or for 2025 here in December, right? If you're just thinking what stock's going to do the best in 2025, what has the most going for it, it's clearly Tesla. There's no other stock with a future in 2025 like Tesla. Yes, there's stocks that have good outlooks for 2025 that should do good in 2025. But even if Tesla fails 50% of what they expect next year, it's still going to be a great year for Tesla. You do not want to bet against that. And I think people are starting to position for that. Even at $400 per share, right? If even half of things go right next year, Tesla could be a $500-$600 stock. And those might not sound like great returns to some retail investors, but this Tesla going from, let's say, 400 to 500, that's a fantastic return for the average Joe on Wall Street, or to 550 or 600. That's a great return. So For these reasons, you have to be bullish on Tesla this week, next week, the week after that, heading into the end of this year. And I think there could be a bit of a short squeeze as well. So let me know what you guys think about this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.